Good morning.
Good morning.
Good morning, friends. Here we are for our next session of interaction on various interesting topics relating to taxation. And we are glad that Dr. Ravi Gupta is here again with us to deliberate upon some of the most important aspects of Income Tax Act relating to penalties under various sections 271, A, B, C, D, and all that. Before we start with Dr. Ravi Gupta's deliberation, I'll request Mr. Rajiv Suri, Secretary General of Tax Bar Association, Jalandhar, to please introduce about the bar associations which are associated with today's webinar. Mr. Rajiv Suri, please unmute yourself and.
Thank you, Sandeep ji. It is indeed a matter of great pleasure in announcing to participants that Punjab Tax Bar Association Ludhiana, under able guidance of President Shri Gupta ji and Secretary General Shri B.R. Kaushal ji, has provided a platform to dissemination of professional knowledge in shape of webinars through eminent speakers. In today's webinar, our guest speaker is Income Tax Expert Dr. Ravi Gupta ji, Advocate from Delhi, discussed with us the chapter of penalties under section 270A to 271GA of Income Tax Act. I, on behalf of Punjab Tax Bar Association Ludhiana and Tax Bar Association Jalandhar, thanks all the professional bar association and their office bearers of Punjab and Haryana who have associated themselves with PTBA to make these webinars a success story. I especially thanks all the office bearer and member of Haryana Tax Bar Association, HP Tax Bar Association Shimla, National Association of Tax Professional Punjab, National Association of Tax Professional Haryana, District Taxation Bar Association State Tax Ludhiana, Taxation Bar Association Ludhiana, Taxation Bar Association Moga, District Tax Bar Association Mohali, Taxation Bar Association Rajpura, District Tax Bar Association Bathinda, Patiala Tax Bar Association Patiala, Pathankot Tax Bar Association Pathankot, Hoshiarpur Tax Bar Association Hoshiarpur, Mansa Tax Bar Association Mansa. All these associations and their office bearer association have, with their wholehearted support, made this possible. I hope that with the able guidance of all the members and association, we would be able to achieve much greater heights in the times to come. Thanks to everyone, those who has joining us in the webinar. Now I requested to Shri Sandeep Gol, Advocate, to continue the webinar. Thank you. Thanks. Please continue.
Thank you so much, Suri Saab. I request you to please mute yourself. Now I'll go to Mr. Jaswinder Singh, Vice President of District Tax Bar Association Sales Tax Ludhiana, to please introduce our esteemed guest today. Mr. Jaswinder Singh, please.
Yeah. I welcome all to the webinar. I welcome Dr. Ravi Gupta, our today's guest speaker, to the webinar. Dr. Ravi Gupta is a leading tax consultant and has a vast practical experience in handling tax matters of trade and industry. He is the renowned author of more than 23 books on direct taxes. He has addressed around 3,200 webinars on various topics on direct taxes organized by various institutes and organizations. He is founder, member, and president of Tax Law Educator Society for the last 15 years. He was government appointed member of Committee for Simplification of Income Tax. Presently, he is government nominee member in Central Council of ICI. We welcome you, sir. It's a great pleasure to have you with us. Mr. Sandeep Gol, kindly can continue with the webinar.
Thank you so much. Thank you so much, Sundarji. Request you to please mute yourself.
Yeah.
Now, to Mr. Vineet Thakral, who is the General Secretary of Panchkula Tax Bar Association, an association which is associated with us today, to introduce today's subject. Mr. Vineet Thakral, please.
Good morning to all the members. Thank you for sparing your time. Today is a very interesting and very good topic, penalties under the Income Tax Act. See, the assessee is always timely and consistently making compliance under the Income Tax Act. And the government is always keen that the revenue is gathered from the assessee and use that money for the welfare and other expenses of the government. To make the taxpayer compliant, there are various penalty provisions under the Income Tax Act. through which there is some kind of pressure and on the assessee, so that he's always making compliance under the tax and no default is made on the part of the assessee. Penalties are in under the Income Tax Act. There are various penalties, like penalty for taxpayer for being a non-compliant, penalty for making non-payment of taxes, under-reporting of income, failure to maintain books of accounts, penalty for making false claim, false entries, false invoices, undisclosed income, under-reporting of income, penalties under the TDS, TCS provisions, failure to make payment other than payment in cash. So all these penalties are divided in various sections under the Income Tax Act. And today we are discussing on these penalties. And our today's speaker, Gupta ji, will enlighten us on this subject. Thank you.
Thank you so much, Vinitji. Now I'll go to our esteemed speaker, Dr. Ravi Gupta, to please start his deliberation. Sir, before you start, just one request. If you can share your PPT file on this chat box, that will help the members to download it. Dr. Sir, please go ahead, sir.
I will do that.
Thank you so much.
Thank you, Sandeep ji. Kaushal, Sandeep Goyal ji, Rajesh Malhotra ji, Rajiv Suri ji, Jaswinder Singh ji, Mr. Tukral. First of all, I would again like to express my gratitude to the Bar Associations of Haryana and Punjab for inviting me here. This is the second lecture that we are having on the subject of penalty. Earlier, we had the webinar exclusively on the penalty under 270A. Then Mr. Kaushal has sent me a list of about 11 or 12 penalties, which we will cover in today's webinar. Some of these penalties are with us for quite some time. Some of them have been introduced recently. The recent penalties, the most important ones that we are facing today, 271 AAB, AAC, AAB. We will devote a little more time to these three penalties. Other penalties also, we will go through the provisions and see what they are talking about. Before I come to the topic, I would like to congratulate the Bar Associations for organizing so many wonderful seminars. I was talking to one of the ITAT members here in Delhi, and they are becoming a little more afraid that after this situation, the consuls will become so much learned that we will be facing a difficult time now. Every day you will appreciate we have 3 or 4 webinars being organized by different organizations. And in each webinar, we have 100, 200, 400 participants. So many man hours of teaching, learning is going on during these difficult times that even the law administrators, the members of the bar, etc., the members of the ITAT, the judicial members, the accountant members, they are also becoming a little wary as to how we will face so many learned consuls now after all this learning has taken place. Well, friends, coming to the topic on hand, penalty. What is the difference between a tax and a penalty? To put it lightly, we say that tax is a fine that you pay for doing something right. If you do your business right, you earn your income, you pay the tax to the government. That is a fine upon you again. About 35–40% tax you pay to the government. And we say penalty is a tax for doing something wrong. So if you default, if you commit a default in any of the provisions, then you are visited with a certain amount of penalty for the default. Penalties you will see under the Act, some of them are those where an assessee conceals his income, tries to save his tax, tries to evade his tax liability. And some are for your failures to do your duty under the Income Tax Act, like non-reporting of certain matters, like non-maintenance of records. Even those attract penalty. If we do not have the penalty provisions under the Act, then it becomes very difficult to implement the provisions that have been inserted. So therefore, we have almost for every obligation on this assessee, we have a penalty which has been prescribed. If you don't do this, you will have to pay this penalty. The trend that we are seeing, the recent trend we are seeing that the penalties are becoming more and more harsh. Earlier, the penalty was say 100 rupees a day, 500 rupees a day. Now penalties are being imposed 5 lakh rupees, right? It could be 100% of the amount. So the penalties are increasing, the vigor of the penalty is increasing day by day. And secondly, you will observe that the penalties which are now being imposed, they are normally being said that this penalty is without prejudice to any other thing. That means these penalties will be added in addition to other things. So we will carefully analyze what the provisions of each penalty state. It will be meaningful for us to understand in what particular penalty. I have a small presentation for you. I will start with the presentation, and after the deliberations, I will share that presentation with the participants. Do you have the presentation on the screen? Can we see the presentation, please? These are the penalties which we are going to discuss today. Kaushal sir, do you have the presentation on the screen? Can I proceed?
Sure, sir. Sure.
So these are the various penalties which have been given for discussion today. In all, we have about 12 penalties which we'll be discussing today. Starting with the first penalty under section 271A. This is an old penalty which we have been facing already. (271A) talks about a penalty for failure to keep, maintain, or retain certain books of accounts. And this provision, you will see says without prejudice to the provisions of 270A or 271. That means even if a penalty has been imposed under 270A or under 271, still this penalty can again be imposed. 270A, we had discussed last time, talks about penalty for underreporting, misreporting, etc. 271 talks about non-furnishing of return of income. So even if penalty has been imposed under these two sections, still 271A penalty can still be imposed if the person fails to keep, maintain, or retain the books of accounts which have been prescribed. 44AA talks about the requirement to maintain books of account, and Rule 6F has specified what are the various books of accounts to be maintained. For example, you have to maintain a ledger, a cash book, a journal, copies of the bills issued, copies of the purchase bills. All these are required to be maintained. The rule also specifies where these books of accounts are to be kept. They are to be kept at the principal place of business. If a person has more than one place, then at the principal place of business that he carries out. And they have to be maintained for a period of minimum 6 years. So all these are requirements of Rule 6F. If a person does not maintain such books of accounts, then he can be visited with a penalty of rupees 25,000. This is a fixed quantum of penalty. It has no relevance with the quantum. It has no relevance with the quantum of the profit or the income. If you do not maintain books of accounts, fixed penalty of rupees 25,000 will be imposed either by the assessing officer or by the CIT appeal. in whatever proceedings are pending before them, they will impose this penalty of 25,000 rupees. Now here, before I come to the next one, it is important to understand that this penalty is covered under 273B talks about that if there is a reasonable cause, if the assessee can explain that the default was because of a reasonable cause, then no penalty may be imposed upon him. So here, what could be a reasonable cause? Say my accounts could not be audited because of certain reasons. I could not maintain my books of accounts. There were riots in the area. Because of whatever circumstances, if I can explain to the assessing officer there were reasonable circumstances, then penalty may not be levied. Then we have penalty under 271 AA. This again is a penalty for failure to keep and maintain certain information and documents in respect of certain transactions. Transactions covered here are mainly international transactions. If an assessee has entered into an international transaction with an associated enterprise, then he is required to maintain certain information and documents as per section 92D. These documents generally pertain to the transaction, what are the agreements entered into, the terms of the agreement, similar transactions, and contemporary data relating to those transactions. The purpose of maintaining these documents is to enable the assessing officer to determine an arm's length price. So for the purpose of determining the arm's length price for transfer pricing, etc., these documents are required to be maintained by the assessee who enters into an international transaction with an associated enterprise. Or in certain specified domestic transactions also. There are very few of them which are covered under specified domestic transactions where you are required to maintain these documents. So if you fail to maintain these documents, the penalty is imposed under 92D1. This penalty again can be imposed either by the assessing officer or by the Commissioner of Appeals. The quantum of penalty here depends upon the value of the transaction. It has been specified to be 2% of the value of each international transaction. So in respect of the transaction, if the prescribed documents are not maintained, 2% of the value of the transaction shall be the penalty which is imposable. Here again, it is a fixed penalty, no minimum, maximum. You have to pay 2% of the value of the transaction if the default is committed. We also have penalty under 271 AA subsection 2, where even if you maintain the documents, but that information or the documents are not produced before the assessing officer as and when required. So here what the penalty says is, you have maintained the documents, you have maintained the records, but when the assessing officer asked you to produce them, you could not produce them, or you did not, you failed to produce them before the assessing officer. Then there is a fixed penalty of rupees 5 lakh. So under 271 AA clause 2, subsection 2, a penalty of 5 lakh rupees can be imposed upon the person who fails to produce the information or documents before the assessing officer. Then coming to the very important penalty of 271 AA-B. 271 AA-B is in respect of search cases, and it is only in respect of the undisclosed income of the specified previous years. What is undisclosed income? What is specified previous years? I will specify, I will deal with them a little later. Now, two relevant sections under 271 AA-B, subsection 1 and subsection 1A. One deals with those search cases where the search was initiated between 2012 and December 2016. This is also relevant for us because some of the search cases, assessment appeals, etc., would still be going on. Therefore, I thought that it is in order that we discuss this also. And all searches which have been conducted after 15th of December 2016, then the penalty is leviable under section 271 AAB subsection 1A. Under the old provision of subsection 1, there were three rates of penalty: 10%, 20%, or 60%. Under what circumstances this was levied, I will deal with that. Under the current provision, under the current searches, there are only two rates of penalty, that is either 30% or 60%. So three rates have been reduced to only two rates of penalty. Now, as I told you, this penalty is only for the undisclosed income of the specified previous year. You would recall that when a search is conducted, then assessments of 7 years takes place. One is the assessment of the year in which the search takes place, and secondly, 6 years prior to the year of search. So in all, the assessment covered under 153A or 153C is for 7 years. Now, specified previous year out of these 7 years means, firstly, any previous year which has ended before the date of search, but the due date of filing the return of income has not expired, and the assessee has not furnished the return of income for that previous year. Let us say the search of a person takes place on 15th of June 2020. Now, by 15th of June 2020, although previous year 1920 has ended, but the due date of filing the return has not expired. He would have filed the return by 31st of July or 30th of November, as the case may be. So on the 15th of June, the previous year has ended, but the due date has not expired and the assessee has not filed the return. So this is the first case of the specified previous year. And secondly, the year in which the search is conducted. So in this case, year 2021 will become the search year. So only these 2 years are covered under the specified previous year. Let us say if the search takes place on the 5th of December 2020. If the search has taken place on 5th of December 2020, then the due date has expired. So first clause will not become applicable in that case. Then only the current year will be the specified previous year. Or if I take another case, come back to the old provision, if the search was conducted on 15th of June 2020, although due date has not expired, but if the assessee has already filed the return, even before the due date, in that case again, clause 1 will not be applicable. So there will be only one specified previous year. So this penalty is applicable only for the specified previous year or years, whatever the case may be. And as I said, it is in respect of only the undisclosed income. Naturally, if the income has already been disclosed, there is no question of a penalty. So only if there is an undisclosed income relating to these 2 years, then we are vested with this penalty under 271 AAB. Undisclosed income again has been defined. It refers to any income of the specified previous year represented by any money, bullion, jewelry, or other valuable things, or any entry in the books of account or other documents, transactions found in the course of search which has not been recorded in the books of account before the date of search, or has not been otherwise disclosed to the commissioner, etc., before the date of search. So any money, bullion, jewelry, valuable article, etc., which is found during the course of search, which is not recorded in the books, or any entry, maybe regarding purchases, maybe regarding sales, which has not been entered in the books of account, that will be taken to be undisclosed income. And secondly, we say any income of the specified previous year which is represented by any entry in respect of an expense recorded in the books of account, maintained in the normal course of business, which is found to be false. So if an assessee has been booking certain expenses, claiming the expenses in his P&L account, in his books of account, and as a matter of search, in the course of search, it is found that these expenses are not genuine, that these are bogus expenses, then that will also become a part of the undisclosed income. So it could be either a passive act of not showing something, or something, expenses, etc., which have been claimed, which are not correctly vouched, which do not have substance. So in either of these two cases, we will call that an undisclosed income. So if there is an undisclosed income which pertains to these two previous years, then the penalty is leviable under 271AA. Now this penalty, again, as I mentioned, is notwithstanding anything contained in any other provisions of this Act. That means this provision overrides all other provisions of the law, of the Income Tax Act. So whatever penalty may be leviable in any other provision, this penalty is overriding any other provision. Under the old provision 271AA(b)(1), that is searches conducted prior to 2016, as I told you, we have three rates of penalty. First is 10% of the undisclosed income. This is a small penalty of 10%, provided certain specified conditions are satisfied. Firstly, during the course of search, the assessee should admit that undisclosed income in the statement which is recorded under 132(4). Right? During the course of search, a statement is recorded under 132(4), and in that statement, the assessee admits that this is my undisclosed income. He should specify the manner. Sorry. He should specify the manner in which the income has been derived, substantiates the manner in which the income was derived, pays the tax along with interest on or before the specified date, that is the specified date for filing the return, and furnish the return of that year declaring the undisclosed income. So these are the 5 conditions which he must satisfy. If he satisfies these conditions, then the penalty to be imposed on the undisclosed income will be only 10% of the undisclosed income. Second case could be that he did not admit it under 132(4), but in the return of income that he furnishes for the search period, he declares such income. So when he files the return under 153A or 153C, then he declares such income as such return and pays the tax. So then he has to pay 20% tax. And thirdly, if he is not covered under first or second situation, then the penalty will be 60%. That is, the assessee has not admitted it and has not disclosed that in the return. Then he has to pay a penalty of 60% of the undisclosed income. Now, these 3 rates we will see under the new searches have been reduced to 30% or 60%. 30% conditions for 10% which were earlier there, same conditions. Right? So if there is a search conducted after December 2016, the assessee admits the undisclosed income in the statement, specifies the manner, substantiates the manner, pays the tax, and furnishes the return. Then he has to pay 30% of the undisclosed income. Earlier it used to be only 10%. Now it has been enhanced to 30% of the undisclosed income. And if he does not declare it or does not pay the tax, then he will have to pay 60% of the undisclosed income as a penalty. Remember, again, I am emphasizing that this penalty is only for the undisclosed income of the specified previous year. If it is not a specified previous year, that means the earlier 5 years covered under search, then the penalty will be levied under other provisions, maybe under 270A, right? Or if they are earlier than that also, then maybe 271(1)(c). Only for 2 years, that is the specified previous year, we will be visited by this penalty. This penalty can be imposed only by the assessing officer, right? Because, as I said, that here we are dealing with a case where the income has been offered under 132(4). So this is an initial year, so the penalty will be imposed by the assessing officer only. and where penalty has been levied under this section 271AB1 or 1A, no penalty will be levied under 270A or 271(1)(c). This becomes an exclusive penalty for the two specified previous years in respect of the undisclosed income of these 2 years. Then we will not be visited with the penalty under 270A or penalty under 271(1)(c). 273B is not applicable to this section. Right? 273B, as I told you, was applicable, and under this we have a lot of sections which are covered here, which say that if the assessee has a reasonable explanation, if he has a reasonable ground for the default, then penalty may not be levied. But if there is undisclosed income of the specified previous year, penalty is levied under 271AB, AA without any applicability of 273B. That means here you do not have an opportunity to show that this was because of reasonable cause. Right? So undisclosed income, we rule out any possibility of there being a reasonable cause for not disclosing an income. So here penalty is absolute. You cannot escape the penalty by showing that there was reasonable cause for not disclosing the income. (271AA)(c). This again says notwithstanding anything contained in this act other than the provisions of 271AA. So 271AA, if it is a search case, we will impose a penalty there. If it is not a search case, then no other provisions will be applicable, irrespective of any other penalty. This provision will apply. 271AA(c). And 271AA(c) penalty is attracted only when there is an income which has been assessed under section 68, 69, 69A, 69B, 69C, or 69D. Now you will appreciate that in all these sections, wherever an addition is made by the assessing officer, the rate of tax is covered under 115BBE. And the rate of tax in that case is about 78%. 60% tax plus 25% surcharge makes it 75%, plus 4% cess on 75% makes it 78%. So an assessee has already paid tax of 78% here, if there is any income which has been assessed in these sections. Therefore, it was felt that it would not be reasonable to impose a higher penalty in these cases. So therefore, we had a special penalty under 271AA(c). This penalty says that there will be a penalty only of 10% of the tax payable. So 10% of the tax payable under section 115BBE, that shall be the penalty imposable under section 271AA(c). It shall again be imposed by the assessing officer. It is 270A is not applicable, as I just mentioned. 273B again is not applicable in this case. So wherever an income has been assessed under section 68, 69, etc., I cannot claim the benefit of there being a reasonable cause. So 273B excludes 271AA(c). 274 and 275 sections will apply. 274 relates to the procedure for imposing penalties. 275 deals with limitation. These two sections will apply to almost all penalties. So they are applicable to 271AA(c) also. Now here, there is a provision which says that if the assessee has declared the incomes specified under these sections in his return of income, if any income under 68, 69, 69A, etc. has been disclosed in the return, then there will be no penalty. If it does not disclose it, then only penalty under 271AA(c) is to be imposed. But it is very difficult to understand as to under what circumstances will an assessee declare an income in his return. 68, 69 all deal with undisclosed tax credit, unexplained cash credits, unexplained investments, unexplained money. So I am yet to come across a case where an assessee himself in his return says that this is my unexplained investment or this is my unexplained money and I'm ready to pay 78% tax on this. But if there is such a case where the assessee has already declared this income in his return, then there will be no penalty under 271AAC. If these additions, and most of the cases these additions are made by the assessing officer only, then he will also impose this penalty of an extra 10%. Now coming to 271AAD. This is the most recent penalty which was introduced in this Finance Act 2020. The most recent and the most dangerous penalty, I would say. As I just mentioned at the beginning, as we keep on inserting new and new penalties, each penalty is harsher than the old penalty. So this penalty we will observe, we will study, is the penalty which has been imposed with effect from 1st April 2020. That means all offences committed under this section on or after 1st of April 2020 will be covered by this penalty. The penalty is 100% of the amount of false or omitted entry. Right? This penalty is for making a false entry or omitting an entry in the books of account. It is to be imposed by the assessing officer. Again, 273B is not applicable in this section. So this was the preliminary about this section. The reason for inserting this section was basically the defaults committed under GST. As we all know, there was a huge racket of issuing fake invoices. Fake invoices were being issued by many persons to claim false input tax credit. So fake invoices were being issued without actual supply of material or services. And this was running into thousands of crores of rupees. You would have read in the newspapers 500,000 rupees, 5,000 rupees, 5,000 crore rupees of tax was being cheated through the fake invoices. So we had very rigorous provisions under the GST. This was also covered under prosecution proceedings under the GST. Simultaneously, the government thought it fit to impose a penalty also under the income tax. So if under the income tax these false invoices are found, then we have imposed this new penalty of 271AAD. Right? It is basically to cover the racketeers who do not actually carry on any business. They are only in the business of issuing invoices. So this was the background under which this provision was inserted. This reasoning was given in the memorandum in the notes on clauses through which this section was introduced. So this was the background which the government has given, and it is this background that we should study the provisions of 271AAD. Mostly, as I'm saying, these were to cover the frauds under GST. Now, when is 271AAD1 applicable? We will have two basic provisions here, 271AAD1 and AAD2. As we just said, 271AAD is without prejudice to any other provisions of this Act. That means even if a penalty has been imposed under any other provision, maybe penalty has been imposed under 270A, still this penalty can yet be levied in spite of the other penalties that have already been levied. So this is without prejudice to any other provisions of this Act. See, now what would happen, we will come a little later to a false entry. If there is a false entry in the books of accounts, some bogus bills have been found recorded in the books, then what will happen? First consequence, the expense will be disallowed. The assessee will be required to pay tax on that. He will be required to pay interest on that. So that is one aspect, paying the tax along with interest. Second consequence could be that he could be visited with a penalty under 270A for underreporting through misreport. So 200% of the tax can be imposed as a penalty under 270A. Thirdly, this penalty can yet be imposed because this is without prejudice to any other purchase. Now, there could be a debate on this issue whether for the same offense a person can be subject to two penalties. But the provisions of this law is very clear. We will have to wait and see what are the judicial pronouncements on this. As I said, this is a very recent section which has been introduced, so we do not have any judicial guidance on this. But the section is very clear. It says it is without prejudice to any other provisions of the Act. Then it proceeds to say, if during any proceeding under this Act, so it is not only the assessment proceeding, it is any proceeding under this Act. This proceeding could be rectification proceedings, could be reopening proceedings under 147, 148. This could be search proceedings, could be survey proceedings, could be investigation proceedings. So if there are any proceedings under this Act, and these could be for any assessment year, it is not necessary that only that assessment year proceedings are going on for which there is a false entry. It could be any proceedings under this Act for any assessment year. If it is found that in the books of account maintained by any person, so here we are covering all categories of persons, and then this person may be the assessee whose proceedings are going on, maybe any other person. So this is a very widely drafted provision. It is without prejudice to any other provision. It is during any proceedings of any person, books of accounts maintained by any person. Substantially, there are two provisions. If it is found that there is a false entry or there is an omission of an entry which is relevant for computation of total income of such person to evade tax liability. So there are two limbs of this penalty. Let us try to understand this. First is a per se penalty for a false entry. So as soon as the assessing officer finds that there is a false entry, the penalty automatically is attracted. No further thing required. What was the purpose of the false entry? What is the consequence of the false entry? We are not concerned with that. If there is a false entry, you are visited with the penalty. What is a false entry? I will deal with that a little later. So first, per se, false entry attracts penalty. Secondly, if there is an omission of an entry, right? If there is an omission of an entry, then we will have to see what is the effect of this omission. If this omission is relevant for computation of the total income for the purpose of evading tax liability, only then the penalty is attracted. So in case of omission of an entry, the assessing officer has to prove that by reason of the omission of the entry, the income has been underassessed or could have been underassessed, and that purpose is to evade tax liability. So in both these two circumstances, the penalty can be levied. Either there is a false entry in the books or there is an omission of an entry. Right? These provisions I had highlighted that this is without prejudice to the provisions of 271AA, any other person, 278AA now we are talking about, where the penalty is on any other person. So here, penalty could be on the person whose books of accounts are being kept. Secondly, it could be on any other person also. Right? We'll come back to this. First, let us try to understand what is a false entry. Right? False entry here refers to a forged or falsified documents, such as false invoice, or in general, a false piece of documentary evidence. Now here, if I keep in view the memorandum through which this provision was inserted, it was basically in respect of false invoices. False invoices being issued in order to enable the assessee to claim wrong input tax credit under GST. Now, if with that background I read this, then all other documents, etc., should relate only to the false invoice. What could be other false pieces of documentary evidence? Could be a debit note, could be a credit note, could even be a false bank statement, a fabricated false bank statement. But if I give a restricted meaning, it should refer only to the false invoice or something related to that invoice. Right? If I enter in my books of accounts bogus invoices, fake invoices, then this is the provision which deals with that. I'll be attracted with this penalty. Secondly, we say a false entry would also include an invoice in respect of supply or receipt of goods or services, or both, issued by a person or any other person without actual supply or receipt of such goods. Now, what is the difference between first and second? In the first case, it is totally a forged document. That means the assessee himself has created an invoice. No one issued that invoice to him. He has forged that invoice. He could take a copy of invoice issued by a genuine supplier, copy that invoice, use that GST number, use that PAN number, and create a false or a forged invoice. That is the first case. In the second case, the invoice is genuine. It has been issued by the other person. That person does exist, but that person has issued the invoice without actual supply of receipt of goods or services. That means only his business is only to supply invoices. He's a racketeer, not supplying any goods, not supplying any services, only in the business of issuing invoices. That is the second case. Third case is a false entry in respect of an invoice, in respect of supply or receipt of goods or services, or both, from a person who does not exist. So naturally, if the person does not exist, the invoice issued in his name would always be a false or a forged invoice. So these are the three circumstances which have been explained to be a false entry. So if I have in my books of accounts any forged bills, any invoices which do not represent any actual supply, or they are from a person who does not exist, then this will be called a false entry in my books. What is the effect of this false entry? Whether it impacts my profit or does not impact my profit is not relevant. As soon as the assessing officer finds that there is a false entry due to any of these three clauses, then he will automatically impose a penalty which will be 100% of the amount. Right? So this is the first case where we had said, right, that there is a false entry in the books and therefore there will be a penalty which is attracted. What is false entry? We have just seen either there is a forged bill which has been entered, or a bill has been issued by a person who has not supplied the material, or a bill has been booked which is from a person who does not exist. So false entry in the books, whether it impacts your profit or not, whether it impacts your tax liability or not, irrelevant, false entry will attract this penalty. Now, where could there be a case where, in spite of false entry, my profit is not being affected? So we come across a large number of cases where a person tries to just inflate his turnover, maybe for availing bank credit. He wants to show higher tax, higher turnover. So on the one side, he shows the turnover at a higher figure. On the second side, he shows the purchases of a similar amount. So both purchases and sales have been inflated. may have no impact on his profit, upon his taxability, but still he has made false entries in his books. And if these false entries are because of false invoices, etc., then in that case, he will have to pay this 100% of the amount as penalty. Coming back to this, the second clause says, wherever there is an omission of an entry, if there is an omission of an entry in the books of accounts, and that omission has an impact of computation of the total income of such person, and it is with the purpose to evade tax, then again, the penalty is being attracted. Supposing a person is issuing fake invoices. Now, when a person issues fake invoices, he is not making any supply. He has no purchases with him. He is only issuing invoices. Would he enter those invoices in his books of account? Right? This person who is issuing the invoices would definitely only issue an invoice and keep it with them, maybe destroy them, whatever he does, but he will not enter them in his books of account because he has no corresponding purchases, etc. Now, this omission of an entry, right? He has issued the invoices on the basis of which the other person has claimed that as an expense, has booked that as his purchase, has claimed the GST credit. Now, this person who has issued the false invoice makes no entry in his books of account, and therefore he is evading tax. So, this person can also be levied this penalty under 271 AAD1 for omission of an entry. So either you make a false entry, or even if you omit to make an entry in your books of account, which affects your taxable income, then the penalty is leviable. One or two more points that we can mention on this penalty. As I said, that this penalty is to be imposed, if I come back to the original section, this penalty is to be imposed by the assessing officer. Now the question here arises, which assessing officer? Supposing there is an assessment going on for Mr. X. The assessing officer finds that X has entered false bills in his books of account. So in respect of X, he can initiate the penalty. This assessing officer also finds that the invoices were issued by one Mr. A. So when he finds that the invoices of X are fake or have been issued by A, who is only issuing the invoice without supply of material, then he can also impose a penalty on A. Now, which assessing officer will impose the penalty on A? That is the person who has issued the invoice. Is it the assessing officer of X or is it assessing officer of A? As per plain reading of this section, even the assessing officer of Mr. X can impose the penalty on A also. So this assessing officer has two choices. Either he can himself impose the penalty or he can refer the matter to the assessing officer of A, who will initiate the penalty against the person who issues the invoice. Another case could be that an assessing officer assessing a person, let us say Mr. A, finds that A is issuing bogus invoices to various persons. Maybe he is issuing invoices to, let us say, B, C, D, E, F, G, H, etc. So many persons. So when he finds that A is issuing bogus invoices, all these persons who are taking the bogus invoices would also be booking them as their bogus purchases. So again, who will impose the penalty on A? Who will impose the penalty upon B, C, D, E, etc.? So in this case, the best course before the assessing officer of A is that he will impose the penalty upon A, refer the matter to the assessing officer B, C, D, E, etc., who will again initiate the penalty proceedings against those persons. So penalty can be imposed, as we said, upon two persons. See, we have seen that provision, it is found that the books of accounts maintained by any person, right? So there could be a penalty upon the person who's being assessed. There could be a penalty upon any other person also who causes the person referred to in section 271 to make a false entry. So one case we have seen here that the person issuing the invoices, the person receiving the invoices, both can be attracted with the penalty. Could there be another category of person who could be covered here? Right? One is the persons directly connected with the transaction. For example, could an employee of a person, if that employee has obtained a false invoice or has booked a false invoice knowing that it is a false invoice, can this clause of any other person even include an employee? I think that could be far stretched. It is not meant to cover an employee, etc. It is the person who issues the invoices, the bogus invoices, the person who receives them. But definitely, if there is a consultant or if there is a broker in between who is arranging this transaction, then that person who is arranging the transaction could be covered under this clause of any other person. Because this person who is the agent in between has arranged for the bogus invoices. This is the person who has caused the person referred to in 271 to make a false entry. So all the persons involved in this chain of racketeers issuing bogus invoices, fake invoices, all these persons could be covered under this clause, even if they have not issued the invoice, they have not booked the invoice, but they have caused the persons to make a false entry in their accounts. So therefore, this penalty can be imposed in so many other persons also. Then another point that emerges from this penalty clause is that this penalty can be imposed only upon a person who maintains the books of accounts. If a person is not maintaining any books of account, then there is no question of the penalty being retracted, because if you will see the initial section 271 it says it is found that in the books of account maintained by this person, there is a false entry or there is an omission of it. So let us take a case of a person who is, say, offering his income under 44 AD, does not maintain any books of account, then this provision may not be attracted in that case. However, if this person does maintain some record, maybe he is maintaining some record to show what is his turnover, and in that record there are certain false entries, then those may also be called books of account, and he may have to pay a penalty again. But if there are no books of accounts being maintained, then no penalty under 271 AD can be imposed upon such person. I think these were the basic provisions of 271 AD. And if there are any other queries, any other questions, any issues, I think we will take them when the house is thrown open to the participants. Coming to the other penalties, 271B. 271B talks about a penalty for failure to get accounts audited. 271A penalty we had seen was attracted when a person does not maintain the books of account. If he has maintained the books of accounts but fails to get them audited, where there is a requirement to get them audited under 44AB, then there is a penalty which is equal to 0.5% of the sales or turnover, etc., or maximum rupees 1,50,000. So this is the penalty under 271B. 44AB requires certain persons to get their tax audit done. If the turnover exceeds a certain amount which is unspecified, the turnover is about 1 crore rupee, in certain cases it is 5 crore rupee. So if that person who is required to get his accounts audited does not get them audited, or even if he gets them audited but does not furnish the report within the time prescribed, then he is attracted with a penalty being 0.5% or 1,50,000. This penalty of 271B is covered under 273B. That means no penalty will be imposed if the assessee can show that there was a reasonable cause. Now we have judicial pronouncements to the effect which say that if the assessee has not maintained the books of accounts and penalty has been imposed under 271A, penalty there was only 25,000 rupees, then penalty cannot be imposed under 271B. See, because if a person has not maintained the accounts, where is the question of getting them audited? So if you have already imposed a penalty under 271A, then you cannot impose a penalty under 271B. Other reasonable circumstances could be that the auditor was sick, auditor could not audit the accounts within time, could not give the report. So there could be so many other reasons which the assessee can explain to the assessing officer that because of these reasons I could not get my accounts audited. If we can put up a plausible explanation, then he can save himself from this penalty under 271B. Then we come to a series of penalties under 269 SS, ST, SU, T, etc. First penalty in this series is under 271D, where there is a penalty for failure to comply with the provisions of section 269 SS. Now, what is 269 SS? Okay, I think we don't have that slide. 269 SS says that no person shall accept any loan, deposit, or any specified sum of an amount exceeding rupees 20,000 otherwise than by way of an account pay, check, draft, or any other specified modes. So if you have to take a loan or a deposit, or you have to receive any amount which is called a specified sum, then if that amount exceeds 20,000 rupees, 269 SS mandates it should be by way of an account pay, check, or a draft. If you accept it otherwise than by way of an account pay check, then you are visited with a penalty under section 271D. The penalty is 100% of the amount of the loan or deposit of the specified sum. This penalty will be imposed only by the Joint Commissioner of Income Tax. It cannot be imposed by the assessing officer. The assessing officer, as soon as he come across this transaction, will refer the matter to the Joint Commissioner. Joint Commissioner issues the show cause notice, and then only the Joint Commissioner will impose this penalty. Earlier, this penalty used to be only for loans and deposits. Then people started finding a loophole, finding ways of avoiding this. So they used to take an amount in cash or show that an amount has been received in cash on account of a property transaction, which was neither a loan nor a deposit. So then we introduced this specified sum. Specified sum means any sum of money receivable, whether as advance or otherwise, in relation to transfer of an immovable property, whether or not the transfer takes place. So here, when a person shows that I have received, let us say, sum of rupees 5 lakh as advance for sale of property, books that in his books of accounts shows that I have received this 5 lakh rupees in cash against the sale of my immovable property. Now this is neither a loan nor an advance. So earlier there was no penalty on this, but now this is what we call as a specified sum. He has received this as an advance in relation to transfer of an immovable property, whether the property takes place or the sale takes place or not. As soon as you receive this specified sum, you will, if it exceeds 20,000 rupees, you will be attracting this penalty. Now here we come across certain cases where a person receives, let us say, 10 lakh rupees on actual sale of a property. The sale deed is registered before the registrar. In that sale deed it is mentioned that 5 lakh rupees in cash has been paid towards consideration for sale of the property. Now would that also be covered under the specified sum? One interpretation says, see here it says as advance or otherwise. So the interpretation should be that otherwise should also draw its color from the word advance. If you apply the general principle of adjustive generis, then a word should derive its meaning from the company that it keeps. So therefore, any other transaction otherwise also should be in the nature of an advance. If it is for actual sale consideration, that has nothing to do with an advance. So if a person receives any amount on actual sale of the property, which is mentioned in the sale deed, executed before the registrar, then to my mind, then it is not covered under the specified sum. This should not attract the penalty. But we do not have any major judicial decisions on this. We will have to wait and see how this is being interpreted. So this is penalty under 271D for default under 269 SS. Then coming to the penalty under 271DA, which is for default under 269 ST. ST was a recently introduced provision. I think from 2017 onwards we had this provision. This provision says that no person shall receive an amount of 2 lakh rupees or more. 3 transactions have been mentioned here, 3 cases. In aggregate from a person in a day. So from one person, even if this amount is broken up and on different parts of the day, you receive separate amounts from a person, the aggregate in a day from a person should not exceed 2 lakh rupees. You cannot receive 2 lakhs rupees or more in respect of a single transaction. Right? Supposing a person is buying a wristwatch of rupees 5 lakhs. Can he pay the amount in cash? On a single day, can he break up this amount? No, because this is a single transaction for sale of one particular item. Can he even pay this amount on different days? No. If there is a single transaction, that transaction cannot be more than 2 lakh rupees in cash. And thirdly, in respect of transactions relating to one event or occasion. So if there is an occasion of, let us say, a marriage or a birthday party being celebrated, even if I pay that amount to different persons, to the flower decorator I pay some amount, to the caterer I pay some amount, but it relates to one event, then the total amount of payment should not exceed rupees 2 lakhs. Right? This payment should not be by otherwise than way of account by check, draft, or use of electronic amounts, etc. So these 3 transactions, we had covered this in the earlier session also, where 269 ST we had covered. But if you violate 269 ST, then you are attracted with a penalty under 271 DA. This is basically, as we said, for contravention of the provisions of section 269 ST. The penalty again, 100% of the amount to be imposed by the Joint Commissioner. So just like 271D, this also will be imposed only by the Joint Commissioner. Two notifications have been issued. These are very relevant notifications. First notification says that 269 ST shall not apply to any receipt from a banking company, post office, or a cooperative bank. So if a person receives any amount, maybe 5 lakh rupees from bank, he withdraws from the bank, or from the post office saving bank, or from a cooperative bank, 269 ST will not be applicable. Consequently, there will be no penalty. Second notification says that this will not apply to receipt of a business correspondent on behalf of a banking company. See, certain banks appoint certain agents, mostly in those places where there are no banking branches. So some persons are appointed as agents of the bank to collect some amount from them. So those have been excluded. Receipts by white label automatic teller machines. So certain private companies are operating these ATM machines. So they have also been excluded here. Just like banks have been excluded, banks have their own ATMs. Some private companies also operate the ATMs. They have also been exempted. receipt from an agent by an insurer. So if an insurance company has agents, they receive the amount from the agent that has been included. Receipt by a company or institution issuing credit cards against bills, etc. And receipt which is not included in the total income under 1017A of the Income Tax Act. 1017A deals with any award or rewards which are given by the central or the state government. So if the state government gives a reward, maybe let us say 5 lakh rupees, that amount, if it is received even in cash by a person, because it comes from the government, therefore 269 ST is not attractive there. So these were two relevant notifications which have been issued in this connection. (269 SU). Again, the recent provision which came into effect from 1st of November 2019. So penalty also is a very recent penalty. 269 SU was introduced basically to encourage digital payments. So this section required that every person who is carrying on a business, and if his turnover exceeds 50 crore rupees during the immediately preceding previous year. So if your preceding previous year turnover was more than 50 lakh rupees, you are required as per this provision to provide the facility for accepting payment through the prescribed electronic modes, in addition to the other electronic modes. So here the government has specified 3 modes, that these are the modes which you have to prescribe irrespective of what are the other electronic modes that you are accepting for the payments. In this connection, the notification was issued. These 3 have been prescribed. So every person whose turnover exceeds 50 lakh rupees has to provide the facility for accepting the payments by way of debit card, which is powered by RuPay, by UPI, that is the Beam UPI, and the UPI QR code, Beam UPI QR code. These are 3 electronic modes mostly encouraged by the Government of India. So therefore, this notification says that irrespective of any other mode, you might be accepting the payment by check, you might be accepting through other debit cards, other credit cards, but these 3 also you must provide the customers to make a payment through any of these modes. Then a circular was issued very recently where it was represented to the government that if a person is making only B2B transactions, that is only business to business transactions, he is not dealing with retail customers. Then the government said that if in respect of this person who is only business transactions, if at least 95% of his receipts are in a mode other than cash, then 269 SU may not be applicable to him. Because here you are not dealing with retail customers, therefore you can receive the payments through checks, etc. Even if you do not provide these 3, then also 269 ST will not be applicable to you. The penalty, if you fail to provide these electronic modes which have been prescribed under section 269 SU, penalty is 5,000 rupees per day, for every day during which such failure continues. So this provision came into effect from 1st of November 2019. Thereafter, if there is any person who has not provided this facility, the penalty is 5,000 rupees per day. Right? To be imposed by the Joint Commissioner, and this provision is covered under 273B. Therefore, no penalty shall be imposed if he proves that there were good and sufficient reasons for the failure. So this is regarding the latest penalty under 271 DB for default in 269 SU. (271E) deals with failure to comply with 269T. 269 SS, we had seen, refrains a person from accepting any loan, deposit or a specified sum exceeding 20,000 by cash, etc. 269D forbids a person from repaying the loan or deposit or specified advance otherwise than by way of an account paid check, etc. So 269 SS says you cannot accept it, 269 T says you cannot repay it. If the person repays any loan, deposit or the specified advance in cash, etc., then he is again visited with a penalty of the amount equivalent to the loan, deposit or the specified sum which has been repaid. Penalty again to be imposed only by the Joint Commissioner. So you cannot accept any loan, you cannot repay any loan. You cannot accept any specified advance, you cannot repay any specified advance. If the amount exceeds 20,000 rupees, these transactions of acceptance and repayment all should be by way of an account paid check. Two small penalties more which we have to discuss. 271 FA. Penalty for failure to furnish statement of financial transactions. 285 BA is the relevant section. As per section 285 BA, a lot of authorities have been given a duty that they have to report certain financial transactions to the income tax department. The purpose of reporting that the government, the income tax department knows the major financial transactions of a person. These authorities have been prescribed under 285 BA. These include, let us say, the registrar of properties. If any person purchases or sells any property of more than rupees 30 lakhs, the registrar will report this transaction to the income tax department. Similarly, banking companies, if any person deposits more than 10 lakh rupees in his saving bank account, the transaction is to be reported. Any person who purchases any bank drafts of more than specified amount, pays any amount towards his credit card, that will be covered here. Then persons responsible for registering motor vehicles, they have to report the transactions. Persons entering into sale and purchase of securities have to report the transactions. So all these are financial transactions which are reportable under section 285 BA. Now with the latest development, where we will find that assessees, when they are filing their income tax returns, all the transactions, all these financial transactions are reflected in their form 26AS. So the requirement of this section becomes all the more important, because the government wants that all major financial transactions which a person enters into should be available with the department, and not only with the department, they will make them available to the assessee also in his form 26AS as soon as he downloads that form. This information will now be freely available with all the assessing officers also. So assessee also gets an opportunity to know that these are the financial transactions which have already been reported. When he is filing his return, he must take into consideration that all these financial transactions are duly accounted for in the return of income. Now, because these financial transactions, the reporting of these financial transactions is going to play a major role in filing of the returns, in making the assessments, etc. Therefore, we have made these provisions a little more stringent. So if a person who has to file the financial transaction report does not do that within the time prescribed, then there is a penalty of 500 rupees for every day during which the default continues. So therefore, all these persons who are required to report the financial transactions have to do that within the time prescribed. Otherwise, there is a stringent penalty of 500 per day. Two 71 FA again. Similar to that, where a person fails to furnish a statement within a period specified in the notice 285 BA5, then the penalty is 1000 for day during which the failure continues. Similar to the earlier penalty which we have discussed. Then 285A is again a recent section which was introduced. Failure to furnish the documents under 285A will attract penalty under section 271GA. 285A is basically covering transactions like the Vodafone case. It is mainly concerning an Indian concern where the Indian concern holds the shares, etc., of a foreign company. The shares of the foreign company derive their value from assets held in India. Right? That is exactly what happened in the Vodafone case. The foreign company was deriving the value of the shares from the assets held in India. They transfer the shares outside India. Now here this section says that if there is a foreign company which has assets in India, the value of the shares of the foreign company is because of the assets in India. And that foreign company is controlled through an Indian concern, or the Indian concern has the shares of that foreign company. Then it is the duty of the Indian concern to give the information regarding the shareholding of the foreign company to the Indian income tax authorities. So that if there is any transfer of any shares or management or control of the foreign company, although that takes place outside India, that should be reportable to the Indian tax authorities. So the Indian concern which owns the shares of such foreign company is required to furnish the information under section 285A to the Indian tax authorities. If they fail to do that, the penalty will be 2% of the value of the transaction in respect of which such failure takes place. So if the value of the shares of, let us say, Vodafone was 500 crore rupees or 5,000 crore rupees, I do not exactly know that. So then 2% of that, right, shall be the penalty which is imposable if such failure takes place for maintaining such record or giving that information. Right? So this is the latest penalty which was imposed under 271GA. I think with this we have covered almost the entire penalties which are given to us. Right? This is to what section 285A says. I've explained that already to you, that the Indian concern has to furnish the information if the following conditions are satisfied. The shares or interest in the foreign company derives value from assets in India, and such foreign company holds such assets in India through an Indian concern. Then they have to furnish the information. This is section 273B, which we were referring to time and again, that penalty will not be imposed if the assessee can prove that there was a reasonable cause for the said failure. Most of the provisions of these penalty provisions are covered here. However, 271 AA-B, AA-C, AA-D, you'll observe are missing here. So in respect of these three major penalties, there is no escape even if there is a reasonable cause, or in fact, we'll observe there could not be a reasonable cause here. So all of the penalties can be covered if there is reasonable cause, excepting the three major penalties of 271 AA-B, AA-C, and AA-T. I think, friends, with this we have covered the penalties which were to be discussed today. If we have any questions, any queries, any elaboration required on this, I think, Mr. Kaushal, we can open the house for discussion. And
thank you so much, Gupta ji, for your very nice deliberations. Sir, we have had few questions. Unfortunately, I have lost the chat because my internet connection had some problems. But I remember Mr. Pradeep Goyal, chartered accountant from Barnala, had raised a question. I'll request Mr. Pradeep Goyal to please unmute himself and ask the question. Mr. Pradeep Goyal. Pradeep ji, please unmute करिए अपने आप को.
Sir, good afternoon.
Good afternoon.
कैसे
Sir,
हो?
my query is कि generally in the assessment order, generally assessment order ये वो क्या करते हैं, वो penalty 271A non maintenance of book of accounts की भी लगा देते हैं और 271B non audit की भी लगाते हैं. जब assessing की book of accounts नहीं है तो 271B नहीं लगनी चाहिए. तो उस केस में आपने भी अभी बताया कि कुछ कोर्स के हैं, रूलिंग्स हैं, तो सर कौन कौन से वो केस हैं जिसमें ये डिसाइड हुआ कि नहीं लग सकता?
मैं अभी आपको वो सारे साइटेशंस दे देता हूँ. 3-4 केसेस है. इवन दिल्ली हाई कोर्ट हैव सेड दैट कि अगर देखो बड़ी रीजनेबल सी बात है कि अगर 271A की पेनल्टी लगा दी असेसिंग ऑफिसर ने कि आपके बुक्स ऑफ अकाउंट से नहीं है, तो फिर बुक्स ऑफ अकाउंट से नहीं है तो ऑडिट कहाँ से होगा?
ठीक है सर.
और 271B is covered under 273B. तो दैट इज अ रीजनेबल कॉज कि मेरी बुक्स ऑफ अकाउंट से नहीं थी, तो ऑडिट कहाँ से कराऊंगा? तो आई विल गिव यू दो साइटेशंस. अभी मैं आपको मेल पे डाल देता हूँ.
ठीक है सर. थैंक यू सर.
Thank you so much, Pradeep ji. Thank you, Gupta ji. Now I'll request Mr. Ashok Juneja, our past chairman, respected chairman. Juneja ji, please आप unmute करेंगे. There are few questions he wants to ask.
Yes. Hello.
Sir, go ahead, sir. We can hear you very clearly and loudly.
My question is, actual sale is not made, but cash memo or invoice is issued by a company to another company, only to get bank limit, only to show the bank that we have made the sales and purchases, but actual sales and purchases are not made. Is it justified?
Sir, देखो, this is the exactly the provision which we are covering under the new penalty. अब one view is that through these invoices, have you taken any GST benefit? There could be a case, let us say I take a invoice of a document where there is no GST involved. ठीक है सर, which is not covered by GST, मैंने उसके invoice ले लिए, तो GST का मैंने credit तो नहीं लिया, but the fact remains that this is a false entry. There is no actual purchase. तो अगर मेरी false entry है books में, then irrespective of whether I am making a profit or not, irrespective of whether it leads to understatement of my income, this penalty will be imposed. So as soon as there is a false entry, we will be visited with this penalty. Although अगर आप उसका reason देखेंगे for inserting the new penalty, reason तो दिया हुआ है for evasion of GST, but जो act में जो section जिस आया है, उस section की अगर हम language पढ़ेंगे, तो उसमें 271AD false entry पे automatically attract हो जाएगा.
GST is paid on that. Income tax is paid on that. Bills are issued, but delivery is not made. So, what is the position of that?
Sir, देखिए, automatically ये false entry में आ गया. False entry.
How it will be proved that it is a false entry when bills that are genuine, payment is made by check?
You are saying that goods have not been delivered.
How it will be known that goods have been delivered or not?
देखो, this is for the assessing officer to establish. अगर assessing officer penalty लगा रहा है, तो वो फिर ये prove करेगा, आपका stock register check करेगा, आपके gate invoices check करेगा, gate के चलान जो entry होती है stock की, वो check करेगा. अगर उसमें entry नहीं है inward की, या उसमें आपके stock में से production के लिए या sale के लिए issues नहीं है, तो he will prove that it is not, no goods have been supplied. So that burden is upon the assessing officer. He will have to establish that this is a false entry.
Yes.
If he is able to establish that there is no supply of goods, only then he will be able to impose the penalty.
Yes. In income from other sources, no actual transaction is taking place. We show the income by putting one line in the income tax return, 5 lakh income. Whether department can ask what is the detail of these income earned?
Sir, if you are not able to explain the source, तो वो इसको 68 में tax कर देगा. He will tax it at 78%.
The source without bill, I am selling some material. source will not be established then. But I am earning the income actually.
Then the burden is upon you to show what was the source of your income. अगर आप सिर्फ उसको इनकम में क्रेडिट कर देते हैं, बैंक में डिपॉजिट कर देते हैं उस अमाउंट को, then the burden is upon you to show that this is from so and so source. मैंने स्क्रैप बेचा था, मैंने कुछ भी करा था, मैंने otherwise if you are not able to explain it, तो वो 68, 69 में उसकी एडिशन कर देगा और आपके ऊपर 78% टैक्स लगा देगा. पेनल्टी नहीं लगेगी because it has been disclosed.
Yes, yes.
But tax rate will be 78%.
Thank you, sir.
Next question again comes from Mr. Pradeep Goyal Barnala. Mr. Pradeep, you can go ahead with your question.
सर आपने इसका जवाब अभी पहले दिया था मेरे क्वेश्चन का. अभी थोड़ा सा डाउट है कि जैसे डेट ऑफ रजिस्ट्रेशन डीड जब होती है, सेलर कैश ले लेता है बिफोर द रजिस्ट्रार, तो वो कैश हम कहते हैं कि 269 की जो के लिए पेनल्टी 271 डी में नहीं कवर होगा. बट सर देयर इज वर्ड अदरवाइज गिवन अंडर द सेक्शन 269 तो सर क्या अदरवाइज में वो डेट ऑफ रजिस्टर्ड डीड वाला कवर है या नहीं कवर है? इज देयर एनी केस लॉ?
मेरे कोई इसके ऊपर अभी केस लॉ नहीं है, बट एक जनरल प्रिंसिपल है इंटरप्रिटेशन का जिसको हम कहते हैं एडजस्टम जेनेरेसिस.
यस सर.
इसमें वो कहते हैं कि एनी वर्ड व्हिच हैज नॉट बीन स्पेल्ड आउट मस्ट डिराइव इट्स मीनिंग फ्रॉम द अदर वर्ड्स व्हिच आर अकम्पनिंग इट.
यस सर.
वो कहते हैं एडवांस और अदरवाइज.
यस सर.
तो एडवांस और अदरवाइज शुड डिराइव इट्स मीनिंग फ्रॉम द टर्म एडवांस. उसी नेचर का होना चाहिए.
ओके.
तो अगर मैं सेल का पैसा ले रहा हूं देन इट हैज नो रेलेवेंस टू एडवांस.
ओके.
इसलिए हमारी इंटरप्रिटेशन ये है कि सेल डीड में जो पैसा रजिस्ट्रार के सामने ले रहे हैं दैट शुड नॉट बी कवर्ड हियर बिकॉज़ दैट इज एक्सप्लेनेबल. रजिस्ट्रार के सामने है, एविडेंस है उसका, सो देन दैट शुड नॉट बी कवर्ड हियर.
गुप्ता जी ये 269 स्पेसिफाई सम कवर नहीं हुंदा, then it will be covered under section 269 ST. Who is receiving payment against one transaction, then he will be covered there.
सर देखिए अगर उसमें कवर्ड है 269 ST में 2 लाख से ऊपर है.
Yes, ये
2 लाख से ऊपर है.
2 लाख से ऊपर है तो
then he will be covered under section 269 ST. From the assessment year 17-18 he will be covered by that section.
तो सिर्फ यही है कि 20,000 और 2 लाख के बीच की अगर ट्रांजैक्शन है तो उसमें बच सकता है.
Yes.
Okay.
Sir, next question comes from Advocate Kapil Chitral. A person is running an immigration firm and gets commission from overseas immigration consultant or university. My query is, should it be shown in section 92 as an international transaction?
देखिए इंटरनेशनल ट्रांजैक्शन इज एप्लीकेबल ओनली व्हेन इट इज अ ट्रांजैक्शन बिटवीन एसोसिएटेड एंटरप्राइजेस. If it is a transaction with an independent concern, then it is not covered under 92. Only if that person from whom he is receiving the payment is a sister concern. अगर इन्हीं की concern है वहां पर या इनका 25% से ज्यादा इंटरेस्ट है, एसोसिएट एंटरप्राइज की पूरी डेफिनेशन दी हुई है, तो अगर एसोसिएटेड एंटरप्राइज से कवर्ड होती है only then 92D is attractive. If it is an independent concern, then 92D is not covered.
Very right, sir. Mr. Rupinder Dhand has asked a question, sir. He says sale bill issued of rupees 2,01,000 in financial year 2019-20, 1 lakh cash received in same financial year, and 1,01,000 received in current financial year. Whether penalty is still applicable?
No.
And if it is so, in which year? And what other reporting a person needs to submit? A person is filing return. A person who is filing return under section 44AD but turnover is above 1 crore.
देखिए इसमें 269T में ST में रिक्वायरमेंट ये है कि if there is a transaction, single transaction of more than 2 lakh rupees,
Right.
you have to take it by check, you cannot accept in cash. पर अगर वो 2 साल में स्प्लिट कर देता है इसको, this is per year. ये ट्रांजैक्शन पर ईयर कवर करेंगे इसको. तो अगर उसने 2 साल में अलग अलग सालों में ले लिया और हर एक साल में 2 लाख से नीचे की है, तो देन ही मे नॉट बी अट्रैक्टेड विद द पेनल्टी.
Alright, sir. I hope this satisfies Mr. Dhand's query. Sir, I think now our If there is any more question, you can raise your hand or you can put this in the chat box. In the meanwhile, we will, since Mr. Gupta has to leave early today, I'll request Mr. Tarlok Bhallaji, our Vice President, to please give his concluding remarks. Mr. Bhalla, you can unmute yourself and please give your concluding remarks. Bhallaji? Bhallaji, आप unmute कर लीजिए सर अपने आप को. आप unmute नहीं है अभी. हाँ, अब ठीक है. Please go ahead.
It's a privilege and honor to be entrusted with the duty to give concluding remarks at a gathering of such an eminent professionals who have joined this webinar. Dear colleagues, ladies and gentlemen, I must say that it was indeed a very successful webinar which covered very useful discussion on penalty provisions which fall under chapter 21 of the Income Tax Act. Entire discussions have been very elaborate, fruitful, and constructive, which contained up-to-date changes covering all important aspects relating to penalty leviable under the Income Tax Act. All these penalty provisions shall be of immense importance under the present scenario of e-assessment as well as faceless assessment made applicable in the coming times. I appreciate Dr. Ravi Gupta ji for the sharing of his vast experiences and candor contributed in this webinar, which has been proactive in coming to the grips with important changes taking place in the penalty provisions under the Income Tax Act. Thank you one and all. And with this, I request Mr. Sandeep Goel to continue.
Thank you so much, sir. We have a couple of more questions, sir. I'll just put it across to you. Before that, one request, everybody is saying that please share your PPT, sir. Everybody, if you can.
I will send this PPT on the mail.
All right, sir. All right, sir. We'll share it on the WhatsApp group then, sir. Right, sir. Thank you so much. One more thing I would like to point out that we, with Punjab Tax Bar Association, we are also joined by two regional tax bar association, Haryana Tax Bar Association, which is a registered body. And we have many of the members who are present today, and they have been regularly making their appearance. Mr. Ramnaran Yadav is the president of that bar. He is also there with us. We are really grateful to Haryana Tax Bar Association for being associated here, and also to Himachal Sales Tax Bar Association, who is also our associated member. Now, Mr. Dhand has asked a second question. He's asking that if the debtor balance is outstanding before implementation of Section 269 ST and cash is received 3 lakhs after this, whether the penalty would be imposable or not.
Yes, it will be, because the transaction of receiving the amount is happening after the section has been inserted. I think even if the debtors are old, still you cannot receive it in cash now.
Sir, one question has been asked. The person has not named himself in the chat box. It says, sir, from which year specified transactions are covered? Sir, from which year the specified transactions are covered?
Specified transactions, you are mentioning about 269 ST.
It looks like, sir, because the question is not very clear. The person is not himself. If he can ask the question, he can raise his hand. I can unmute him. It is mentioned Galaxy Note 5.
I think these are applicable from 2017, 1st of April 2017.
Right, sir. Thank you so much. We have got the PPT in our chat box, and if anybody wants to download it, it can be done. So we are grateful to Mr. Ravi Gupta for that, Dr. Ravi Gupta. Now I'll request Mr. Parminder Johal to please offer. Mr. Johal is not there. Mr. Parminder Johal, if he is there.
President of Ropar Tax Bar.
The President of Ropar Tax Bar Association, Mr. Parminder Johal, if he has named himself with a different title, he can raise his hand. Mr. Parminder Johal. You can just mention in the chat box. doesn't look like that he is there. So I'll request our Secretary General, Mr. B.R. Kaushal, to please offer vote of thanks. Mr. Kaushal ji.
Thank you very much. I sincerely express my thanks to the organizer for giving me this opportunity to make vote of thanks. Today's webinar was the series of 11, which we are dealing in every Sunday. In one Sunday, we are dealing with the income tax matter, and the second Sunday, we are dealing with the GST. Today's webinar was a very important because of the fact that the assessment proceedings are going on and number of penalty proceedings has been initiated by the assessing officers. Mr. Gupta has very elaborately explained various provisions of the penal action and explained the various issues which are relating to day-to-day penal provisions. His presentation as well as deliberation was excellent and wonderful. His vast experience in the field of direct taxes has given us a very knowledgeable aspect. I, on behalf of Punjab Tax Bar Association and other like fellow association, express my sincere thanks to the worthy speaker, Dr. Ravi Gupta, who is a prolific speaker, having vast knowledge in the field of direct taxes. Once again, I thank you very much for Mr. Ravi Gupta ji and the participant. Thank you very much.
Thank you, our worthy Secretary General B.R. Kaushal ji. With this, we are coming to the end of our session. Thank you so much, everyone, for joining us this morning. And I hope everybody has enjoyed as well as has gained benefit out of the deliberations given by Dr. Ravi Gupta. We can see it from the comments which are mentioned in the chat box. So we'll join you next week. We are going to have again a session on the income tax. Mr. Kapil Goyal is going to join us. So we'll send you the details with regard to that. Thank you so much for joining. We'll see you next Sunday again at 11 o'clock. Thank you so much, everybody. With this, I'm ending the meeting. Thank you.